Most people hear the same advice repeated everywhere. Just invest in the SP 500 and you'll be fine. It's said by friends, co-workers, financial blogs, and even professionals. It sounds simple, safe, almost foolproof. And on the surface, it makes sense. The SP 500 has grown over the long term. It has survived wars, recessions, crashes, and bubbles. Historically, it has rewarded patience. But here's the uncomfortable truth most people never realize. A huge number of investors in the SP 500 are still losing money, and they don't even know it. Not because the index itself is bad, not because long-term investing doesn't work, but because the way most people actually use index funds is deeply flawed. The real myth isn't that the SP 500 grows. The myth is that buying it automatically guarantees success. Markets behave logically over time. People don't. On charts, the SP 500 looks smooth and upward sloping. In real life, investors experience fear, excitement, regret, and panic. They don't experience averages. They experience emotions. And that emotional gap is where most of the damage happens. One of the biggest reasons people lose money with index funds is timing, even though index investing is supposed to remove timing from the equation. People rarely start investing when markets feel boring. They don't start when headlines are quiet. They start after long bull runs, after prices have already gone up, after headlines scream record highs. They buy when optimism is everywhere and risk feels invisible. Then the environment changes. The market pulls back. Volatility increases. News turns negative. Red numbers show up on screens. Fear replaces confidence. Instead of staying invested, many people sell. They move to cash. They wait for things to feel safe again. The index didn't fail them. Their behavior did. They bought emotionally and sold emotionally, locking in losses while the market eventually recovered without them. Another major reason people underperform is far less dramatic but just as powerful: inflation, taxes, and fees. When people hear 10% average annual return, they assume that's what they'll feel in their everyday lives. They imagine their lifestyle improving at the same pace as the chart. But that's not how it works. Inflation quietly reduces purchasing power every single year. Taxes take a portion of gains when money is moved or withdrawn. Even small fees, compounded over decades, quietly erode returns. On paper, the portfolio may be growing, but in reality, the improvement in lifestyle feels slower and smaller than expected. You feel richer on a statement, but not necessarily in real life. The third major issue is inconsistency. Many people invest only when they feel confident. They reduce contributions during uncertainty. They pause investing when life becomes stressful or expensive. But compounding doesn't work part-time. It doesn't reward good intentions. It requires consistency. Missing just a handful of strong market periods can dramatically reduce long-term returns, even if you technically stay invested for years. Index investing is often described as passive, but emotionally, it's one of the hardest strategies to follow. It requires patience during long periods of boredom, and discipline during moments of fear. It asks you to do nothing when your instincts are screaming to act. Most people don't fail because the SP 500 underperforms. They fail because they interfere with a strategy that only works when left alone. The biggest risk to your portfolio isn't the market. It's your reaction to it. So how do you actually win with index funds? The answer isn't more market predictions. It's fewer decisions. Automation removes emotion. Automatic contributions force consistency. Reducing exposure to daily financial news protects you from panic-driven mistakes. And just as important is adjusting expectations. The SP 500 is not a shortcut to quick wealth. It's a long-term tool designed to reward patience, discipline, and time. The results aren't exciting year to year. They're powerful decade to decade. Boring investing often outperforms exciting strategies. Discipline beats intelligence. Process beats prediction. The SP 500 isn't broken. It has done exactly what it was designed to do. But the way most people interact with it is broken. Once you understand that, index investing stops being a myth and starts becoming what it was always meant to be: a simple strategy that works only if you let it.